Hello, everyone, and welcome to our recording on what is financial accounting and what are financial statements. You'll find that this is a fairly short recording. This is just to help set the stage for you as you begin to review in depth the three primary financial statements covered in this chapter. So first, let's start with a basic question. What is financial accounting? And that's a good question to start with because that is the underlying premise or topic of chapter 4 in general. Okay, it's also a good question to start with because there are other types of accounting other than financial accounting, including managerial accounting and tax accounting. We will not do anything with tax accounting in this term in this course, nor will you do anything with it in your MBA curriculum. Managerial accounting is important. I'll have some specific comments on that in a moment. First, though, from Investopedia. Financial accounting refers simply to the process of recording financial transactions pertaining to a business. So here we're talking about things like recording a sale made to a customer, whether the customer pays us cash for the sale or not, whether the customer will pay us in 30 days or not, recording that transaction in our enterprise resource planning software, entering that transaction, creating then accounts or assets or liabilities associated with these transactions. All that rolls up under financial accounting. The accounting process includes summarizing, analyzing, and reporting these transactions over an accounting period to determine the resulting effects on a firm's operations, financial position, and cash flows. So for our purposes in this class and throughout your MBA curriculum, you will not be concerned with entry of these transactions. You will not be concerned with the accounting process of recording journal entries, that kind of thing. What we're looking more at is summarizing, analyzing the effects on firms' operations, financial positions, and cash flows. So for that reason, we're going to focus on, here are the financials for last year. Where's our company at based on these financials? And can we come up with tools to make projections about the future and see where that will put us at financially next year? So simply put, financial accounting tracks cash coming in and cash going out on, very important here, on an accrual accounting basis. Accrual accounting involves recording and reporting revenues when they're earned, not necessarily when cash is received from the customer. Okay, so even if that customer is going to pay me in 30 days and I provide them the goods or services, I still count that as a revenue today, in this week, in this month, under accrual accounting principles. And regardless of when the cash comes in. All right, if I make a sale to a customer on what's called trade credit terms, I'm giving them a period of time to pay me back. That's called a credit sale. Okay, that's the nature of accrual accounting. Likewise, anytime an expense is incurred, we record it, whether we've actually paid cash for it or not. That's accrual accounting. For that reason, our income statement will show a measure of a level of profits that will not exactly match up with our level of cash flow. More on that coming up in the future. Financial accounting is obviously of paramount interest to external stakeholders. They're going to want to know, where's the company at profitability-wise? Where's the company at cash flow-wise? What does the company's balance sheet looks like? Financial accounting can be contrasted with managerial accounting, which is only used by corporate insiders. Managerial accounting looks at things like break-even analysis, contribution margins, what level of operating profit is earned per unit sold, what degree of operating profit is earned per business division. Financial accounting is more about aggregating and rolling all these values up across the firm and across its various divisions and product lines. Still, managerial accounting is very important. Think of that as more of like micro accounting analysis, whereas financial accounting is more about like macro accounting analysis. So before we conclude this short video, let's think about financial statements, and we're going to list those on the next slide. Before we do that, I really like for students or participants to think carefully about the whys of financial statements before we get to the here they are. Okay, Financial statements are important because they provide insights on the following: financial activities of the firm, the financial condition and health of the firm that result from these activities, and importantly, the sources and uses of cash. I mean, it's great to know that we produced net cash flow last year of $40 million, but don't you want to know where it came from? Did it come from operations, or did it come from the fact that we just secured a huge loan? We could have been really unprofitable last year and net profit of, say, negative $5 million and secured a loan of $25 million. If those are only two financial transactions or activities, we have net cash flow of $20 million, right? 25 minus 5. But do we really produce that net cash flow organically? The answer, of course, would be no, we did not. So sources and uses of cash are very important. Keep the following questions in mind as you review these topics. What does the statement provide? That is, what is the basic purpose of the statement? What is it telling me? Okay, great. Now I know what it's telling me. What are some cautions about the statement? You know, think about what we'll look at soon when we get to the income statement and look at profitability. One of the key issues with profitability is that not all those sales that are tracked into those profits are actual cash flow, right? That's just one of many issues we might want to think about. We'll talk about cautions with respect to specific financial statements as we get to each one. And lastly, how do business activities impact the statement? How do these micro business decisions activities actually impact the final numbers? That's really, really important to think about. So here are our big three financial statements. First is the balance sheet, and we'll have a separate recording for each of these, but the balance sheet is simply going to show us the assets that the company holds and how they are financed. Very, very important. It'll be ordered in terms of descending order of liquidity, and don't lose sight of it. It's not just showing us our assets, it's showing us how they're financed. There are two ways to finance any asset, and that's really, really important. Our shareholders are going to be very interested in that. Second is the income statement, and this is probably the financial statement that most are somewhat familiar with, regardless of their business background. The income statement shows us the company's degree of revenue generation and our ability to control our costs and expenses. And it's great if we generate $100 million in revenue, but if our costs in aggregate are 130 million, we've got a problem, right? Lastly, statement of cash flows. Statement of cash flows will show us the cash that's actually generated on a net basis across all business activities. And so this is important because the income statement and balance sheet are developed with accrual accounting principles in mind. And so for that purpose, profitability may not, and typically does not, match up with actual cash flow generation. The statement of cash flows, though, will combine and merge, if you will, our income statement with the balance sheet to see what the company's net cash flow position is from the changes in the balance sheet, coupled with whatever happened to our income statement last year. Lastly, I want to close this session with the following. I want you to think about long-term where we're going with this, okay? Analysis with financial statements. It's good to know the nuts and bolts of them, but we also want to think of them as tools that we can use for a further use. So the two key uses of financial statements include pro forma financials, which involves putting together financial projections, and also ratios. With pro forma financials, what we'll typically do is look at last year's financial statements as our baseline, and then apply a growth rate to those financial statements based on in-depth analysis of what we believe growth will look like for our company next year. All right, just simply put, for now, think of the income statement. Top line on that is revenues. If you believe revenues will just keep pace with maybe inflation, inflation is expected to be 5% next year. That means you multiply last year's revenues by 1 plus 5%, or 1.05. You can then easily determine a method that we'll talk about in a later video to track what that 5% increase in revenues would have on overall profitability. And you could do something similar for the balance sheet as well, and then do a statement of cash flows. So pro forma, just read that as projected financials. With ratios, what we're going to do is use certain well-known equations to quantify the income statement, balance sheet, statement of cash flows to help for comparability purposes. One of the comparability issues that you have when you're just looking at raw financial statement data is You cannot accurately compare the level of net income or the level of even cost of goods sold for a company of different sizes, even if it's the same type of company within industry. You have to control for firm size, and that's where ratios come into play. So by ratios, we use a common scale basis or a common scalar that allows us to then say, were we good, were we better than our peers at generating profits after adjusting for firm size? Okay. So we will come back to these topics outside of chapter 4. I'm just setting the stage in this slide of what's to come later in the term. We'll examine these topics at the end of the term when we integrate key topics from economics, statistics, and finance, and also marketing to determine, all these things can come together to help us develop pro forma financials and see what the impact will be on our ratios.